Senator Wu.
Thank you to our witnesses. Can you comment on the impact of the ultra-hawkish policy of the Federal Reserve on the Canadian inflation outlook and the economic outlook? And I'm thinking of a few different transmission mechanisms, which you'll know about. First, of course, is the need for the Bank of Canada to match or even to anticipate Federal Reserve increases so that our exchange rate doesn't fall further than it has fallen already and lead to greater imported inflation. The second is that this same phenomenon is being played out in other countries where perhaps they are having to tighten more than they would want to tighten for the purposes of the domestic economies in order to avoid imported inflation through a falling currency relative to the US dollar. In that situation, if the US has gotten it wrong, and they got it wrong, of course, the last decade, is there, what probability would you assign to an overshooting risk where essentially the US, through a Beggar-Thy-Neighbour policy, drives us all into recession and makes for a much worse situation than what you describe as a transitory inflation would cause for our economies?
So thank you, Senator. You seem to have explained the transmission mechanisms quite well. The Fed policy is the Fed is in a tightening mode, and as you explained, Canada usually has to follow suit, at least to a certain extent, at the risk of seeing the Canadian dollar depreciate sharply, which would further exacerbate inflationary pressures. So that's probably one of the important inputs into decision-making at the Bank of Canada in their decision to increase interest rates. One of the risks of the Federal Reserve in the US, increasing the rates and potentially increasing the rates too much, if that were to be the case, is the risk of pushing the US economy in a technical recession, if not a full-blown recession. But I don't think it'll be, if that's the case, it'll be a very painful recession, maybe a technical recession, which would obviously act as a weight on the Canadian economy, lowering what would otherwise lowering economic growth in Canada because of the very close interdependencies of both economies.
What scope do you think we have to decouple somewhat our approach to interest rate increases so that we don't overshoot as well in Canada and drive the economy into more of a recession than is necessary to bring down inflation?
I'll give probably a brief answer, but the governor or somebody from the bank will probably have a more fulsome answer. I think there is little scope to decouple our monetary policy from that of the US because of the impact this would have on capital flows and also on the exchange rate. And given that 3/4 of our goods and services is done with the US, that decoupling would have major impacts not only on the exchange rate and financial flows, but also on trade.
Thank you very much.